In this presentation, we will continue on with our comprehensive problem working on the financial statements, more specifically working on the balance sheet, more specifically working on the liabilities and equity portion. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Last time we did the asset portion, we found a home for all of these items. If we find a home for everything, we should be in balance and everything should be fine. We're going to go to the liabilities section at this time. As we do this, just remember that we should put obviously the name of the company, which this is an example, don't have it. So we're going to have the balance sheet, and then we should put the date, which is often on test questions and often something that students, or as we learn this, we get it kind of right. We start to memorize it after a while and still not really grasp or understand it fully. So this is going to have just one date as of a point in time, as opposed to the income statement, which will have a date range. What that means is that the balance sheet accounts, it doesn't really matter what the time period is in terms of the beginning and ending time period for the balance sheet. It could be for the week ended, for the day ended, for the month ended, for the 5-year time period ended. The balance sheet, it is what it is at the end of the time period at that point in time. Whereas the income statement is a performance measure. So the balance sheet's telling us where we stand. The income statement is telling us the story, what happened over that time period. And therefore, we need the beginning and ending date. So just be aware of that as we go through these. And that'll become more apparent as we see the relationship between the financial statements and as we see when we go to the closing process. Okay, so now we're just going to the liabilities section. We have these 3 liabilities. That's all we have to deal with in the liabilities section, which is nice. So there's the same kind of thing with the liabilities. We have current liabilities and long-term are the most common 2 breakout portions of the liability section. Current liabilities are those which are going to become due within a year. It's just an arbitrary number. And current liabilities, it's just an arbitrary number. We just said, hey, we're just going to pick out a year out. That sounds reasonable. We want to know how much is actually you need to pay within a year. And that's nice because it's comparable to the current assets or the quick assets or even cash to try to determine if someone is able to pay off their current liabilities. Okay, so that means that we're just going to have these and we just need to determine if they're current or not. Are they going to be paid or done within a year? Accounts payable that's usually due within like 30 days. Wages payable because that's like due within a few days because we pay every 2 weeks or something like that. And then unearned fees typically is as well, because we're going to hopefully do the work. That doesn't mean we're going to pay it back in money, but we're probably going to do the work within a year. So we don't have any long-term liabilities in this section. That'll become, we'll see the effect on that on our financial statements in a second, but we're just going to pull these over into the current liabilities. Now we could just copy and paste them, or we could use formulas. I'm going to use formulas here. So within cell J5, we're just going to say equals, point to the accounts payable. Noticing the formatting, the current liabilities, we have liabilities, total category, then subcategory current liabilities, indicating it's a current liability with multiple accounts. One of those current liabilities being accounts payable, it being indented to indicate that it's a subcategory. Then we're going to have wages payable underneath that. We're going to say equals, point to the wages payable, and enter. Oh, not the amount, but the dot. We're going to say equals wages payable and enter. And then, of course, we have the unearned fees. So within J7, we're going to say equals and point to the unearned fees and enter. Now, again, we could do the autofill in order to do that. I'm just going to delete this just to show. If we delete these and put our cursor on accounts payable, we could autofill it down like so. So there we have that. Okay, so now we're just going to put the amounts. Now we're going to put them in the inner column again, not because they're debits and credits, but because we want the subcategory in the inner and sum them up in the outer. Now note that these are credits here. I want to use formulas, but I don't want to pick up the credit. I don't want a negative number here. So to fix that, instead of saying equals, we will say negative of that number. And that's just going to pick up that number and flip the sign of it. So there we have that. I'm going to do the same thing here, negative of this number for wages payable. Same thing for unearned fees, negative of this number. So there we have that. Now I could do that again. I could just autofill that down. So I'm going to delete these just to show that. If we had this one doing what we wanted with a negative and everything, and then we put our cursor on the autofill and had auto drive it down, Dr. Phil do the calculation, it would then do as we would expect and hope that it would. Now, what we're going to have is the subtotal now, and you would think it would be called current liabilities, total current liabilities. And normally it would, except that we don't have any long-term liabilities. And so we're just going to call it total liabilities. Now, why would we do that? Just note that this is kind of quirky things you've got to just realize in a financial statements. If we had no long-term liabilities, what are our options to put this formatted? We could put a total current liabilities, and then we could put long-term liabilities in a 0 and subtotal them together for total liabilities. Or we can just say total current liabilities and not have anything that says liabilities, which is the name of the section. Or we can do what we're doing here. We could say current liabilities subcategory. These are all current, telling our reader they're all current. But then when we pull it out over here, we're just going to say, hey, these are total liabilities, which means they're all current and they're all the liabilities. So that's how we'll format this. We're going to put it over here by saying equals sum, double click the sum function, highlighting these columns, 11,000 plus 1,005 plus 1,000 giving us 13,500. We'll go ahead and underline this cell by going to the Home tab, Font Group Underline. So there's our liabilities. Let's double check it over here. If we highlight these, it adds up to 13,500, 13,500. These are credits. These are debits. I mean, these are not debits. These are a plus and minus format. That's okay. So that's what we expect. We don't want credits over here, in other words. So there is that. Now, the equity section is going to be one of the most confusing, typically, of the balance sheet. And again, it's the reason that a lot of books will say that you need to do the income statement and then the statement of partners' equity before moving here. But again, I think this gives us so much more kind of a big picture view of what's going on right away, and it lets us work from top to bottom. So the equity section here, I'm going to highlight these. It has to do with partners' equity, of course, because that's the type of owners we have, partners. And all the equity section for a partnership is really labeling out, just like the liabilities, is labeling out kind of what we owe, who we owe in a way, the types of things we owe at least. The partner's equity is really saying what the partnership owes to the partners. And there's 3 partners. So it's going to consist then of 3 capital accounts saying of the total assets, this is what is owed to partner Smith, Jones, and Brown. So it'll be equal then to assets minus liabilities. So I'm just going to copy that. Well, I'm doing this with a formula again. In J11, we'll say this equals the capital account for Smith. This equals the capital account for Jones. And this equals the capital account for Brown. Now I'm going to make a common error again and it'll be wrong. And then so see if you can catch the error, see if you can see what's going on. And then we'll go back and fix it and discuss how we're going to go about doing this. So first we're going to pick up the capital accounts, and it says the capital account for Smith is 40,000. And note that this trial balance, if we had a date on it, it would be dated January 31st. This is the trial balance as of January 31st. And this says capital account for Smith as of the trial balance of January 31st, which is the date of the financial statements. So you'd think we could just pick this up, right? I could just pick this number up and say, okay, K11, it's a credit, so I want to flip the sign. So I'm going to say negative of this number and enter. And then here's Jones, it's a credit. I'm going to flip the sign by saying negative of that number. And then here's Brown. I'm going to flip the sign by saying negative of this number and enter. And then if we sum that up, I'm going to underline this. Home tab, font, underline. And then we've got total partners equity. We could type in here. So we'll sum this up. And that'll be the 40, the 50, and the 10. So we're going to add that up equals the sum of the 40, the 50, and the 10, which will add up to 100,000. Now, I'm going to add up the outer column and see if that matches over here. These two should match. So because liabilities and equity should equal assets, or assets should equal liabilities and equity in accordance with our accounting equation, as we can see up here. So let's do that. And notice again, we're only going to add up the outer column now because I've subcategorized all the liabilities, subcategorized all the equity section. So it's not like down here, it's not like I have to go here and then pop over to this column and then jump back over to this column. No, we only have to do things to one column at a time. And so we're going to be here in L16 and we're going to say equals SUM, double click the sum function, highlight these outer column numbers, the 13.5 and the 100, and enter. Okay, so we're out of balance here because we got 119,100 and 113,500. So what happened? Like, what's wrong with this? Now, you're probably saying right off the bat, what about these, these things are kind of right in between there, and those are the draws. So maybe this is off by the draws, which would be, a good thought. So we're going to say 119,100 minus the 113,500 means it's off by 5,600. Now the draws are less than 5,600, 500, 600, and 400. So it's not just to the draws that we're off. That's a component, but that might be part of it, but it's not everything. And really what the problem is that the income statement, remember, is going to be closed out to the capital accounts. The problem really is that even though the date of the adjusted trial balance is January 31st, the end of the time period, it's showing the capital accounts typically as of the beginning of the time period, or in this case, the beginning of the time period plus investments, if there were investments into the partnership, as there was here because it's the first month. So these accounts are really deceiving because they're not as of January 31st, because we've really broken it out between the equity section and all the temporary accounts, which are going to be part of these capital accounts once we do the closing process. So the capital account is really all of this. All of this is the capital account, the 105,600, the 105,600. So that's what the capital account is going to be. Now we don't know. I mean, we may not know. We could probably figure this out, but we don't know exactly what the income allocation is to the partners yet. So it's difficult for us possibly at this point to break out who we owe to, but it's not difficult for us to just say, let me put the total number here and see if we're in balance, just to see if everything's working as it should. So I'm going to delete these three. These three are wrong. That's not going to be correct. What I do know is that this whole thing all together, if I put this whole thing all together into my equity section, which will be the sum of the three capital accounts once we figure that out, then we'll be in balance. And to do that, I need to flip the sign because this will be a credit. If I sum this up, it'll be a credit 105,600. I want it to be a debit. So I'm going to say negative sum instead of equal sum. And then we'll just sum up all of this. So the whole blue section, and enter. And that'll put us in balance. What it doesn't do for us, it doesn't break out who the owners are. And to do that, we will go through the statement of owner's equity to figure that out, to do that allocation. We'll probably, oftentimes, if it was more complicated of an allocation, we would need a worksheet outside of the financial statements entirely. And if we had that worksheet, we can just plug the numbers in here. But what I want to point out here is that to me, it's easier to look at this and say, I want to know that my assets are correct. I want to know that my liabilities are correct. And the way to do that is to, start with them and then give me the total in equity. And that gives me pretty good assurance here. Right now I could say, I'm in balance. The whole thing is balancing. I feel pretty good about the situation. All we have to do now is recalculate this number by breaking out the income statement, as we would anyways, but now the income statement is less to me, right? It's not the whole accounting equation. It's not assets equal liabilities plus equity as this is. It's just a component of equity. And we know what total equity is now. We just need to break out its components, which will be the income statement, net income, and then the equity section, the statement of equity. That's what we'll do next time. So we'll do the income statement. That will be connected to the statement of equity. And the statement equity total then will match this 105,600 and we'll provide more detail in terms of how we're going to break that out into Smith, Jones, and Brown capital accounts. For more accounting information and accounting courses, visit our website at accountinginstruction.info.